Hello, folks. We're an educational company here at Pro Trader Strategies. So please hit that subscribe button if you are interested in trading options or just learning about the markets. We're here to educate you guys on all kinds of different aspects around the markets. So please hit that subscribe button so you guys get access to it. Also, if you have any questions, comments throughout this video, over there in the comments box, I'm going to be keeping an eye on that because I want to make sure you're clear of concept throughout this. So if you have any questions, please throw it over there. I don't mind stopping and making sure that your question is answered before we move forward, because I don't want it to snowball on anybody. And if you have a question, there's probably somebody else out there that has the same question. So please feel free to reach out at any time there. All right. And finally, smash that like button. It really does help us out. We do really appreciate that. And finally, I'm Eric Wilkinson. I'm going to be your host along with Wrigley and Belden right there. Those are the two dogs that I had to bring in here. Hopefully that was not a mistake. I was trying to keep them quiet, but they will probably just stare under the door for the next hour. And please, hopefully they keep it quiet back there. All right. So we are talking about swing trades and implementing options in and around those types of swing trades. We've already gone through the bullish moves. Now we're moved on to the bearish moves. And today we're going to be talking about a bearish move, but we have high implied volatility. So what does that mean for our strategy? Well, I'm going to kind of let the cat out of the bag here in just a second, but we're going to be talking about the short call implemented around a swing trade. And something to note, if there's nothing you take away from this, with the short call, we know that we have to have high implied volatility, okay, for that underlying. I'm not talking about the VIX here, folks. So when you hear me talking about volatility, rarely am I really referring to the VIX, unless I'm talking about the broader overall picture. But when I'm talking about volatility, I am usually specifically talking about that underlying XYZ stock or ETF, whatever that is. All right. So that's one of the major things that we're going to be looking at today. But first, we have to find a swing trade. And in order to find a swing trade, we really have to figure out what is a swing trade, right? Well, you've heard of a day trade, maybe. Well, that's a trade that happens today. You're in and out of it today. A swing trade is something that lasts more than 2 days, basically, or 2 days or more. So you got into it today and you get out of it tomorrow, that would be considered a swing trade. But let's really drill down on this. A swing trade really is, you look for an overall trend in the markets. Sorry, I thought I had my pen up there for you folks. Let me go. Pen, back to the pen. Overall, you're looking for a trend, right? So this would be a bullish trend. Overall bullish trend. And you've seen market neutral trends and bearish trends, right? All right. Well, that is the overall trend when you kind of blur your eyes and you can see this underlying either running straight up or just moving sideways in a boring way. Then what we need to do is find support and resistances. So when we're looking at what the market's doing, we're kind of looking at stuff like that. And you try and find where the market loses momentum to the upside and gain support, or the buyers start coming in on the downside, right? So we have our support and resistances. That's the next thing you want to try to determine with that, because that really is going to be where you have your line of delineation. You make your decision. All right, in this case, we've come up and tested this resistance area, started rolling over. That would be a good strike location or a good entry for a strategy for a bearish move. So that's why we're looking for those on swing trades, is because when you check it out, you will see that we will be able to find these support and resistances relatively easy just on basically any underlying asset. So we found resistance, support on all of these underlyings, or right, we don't know really what the underlying is, but on these trends. And then ultimately the key to our trade is the pattern within the trend. And so we've got a bull trend here, but you can see here that our pattern is turning negative or bearish. So we have a bullish trend with a bearish pattern. We're going to set up our trade on the pattern, but we need to find these other two steps in order to know where our risk lies, okay? And here we have a neutral trend going sideways with a bullish pattern within that, all right? And I'm not always necessarily looking for a bearish trend with a bearish pattern. I'm just trying to give you examples that those are things that we would look for, you know, and you could have a bearish trend with a bullish pattern. Okay. But ultimately, first thing you do is look for the overall trend, then try and find those support and resistances, whether you're using Fibonacci's or kind of blurring your eyes. I don't have any problem with like blurring your eyes to see where the market finds resistance and supports. That is definitely something that I used to use. And sometimes I wonder if that is more important because I rely on those Fibonacci's for entries sometimes. That usually when you blur your eyes, you can kind of see an area where it started losing momentum and it's not necessarily up against a full-on Fibonacci there. As a matter of fact, you guys saw me talking about a trade just recently where I had an old Fibonacci on a chart, and I had my new Fibonacci on this chart, and I had a swing trade set up. Well, I could see that there was a different line where there were some support levels there, and it just so happened to line up with my old Fibonacci that was anchored to a different high. And so I drew that in there because that has acted as support in the past. It should act as support in the future. And it has. So it is almost more important sometimes to look at those other areas than just the Fibonacci's, okay? Or any of your other 50-day simple moving average, whatever you use to find those support levels or maybe a possible bounce, okay? So this is what we're looking for. Support, resistances, and then the pattern. The pattern is the thing that is going to be key. But what happens is we'll set it up in a real life example here where we can see this is a sideways or a neutral trend, right? This underlying traded sideways. And when I was talking about blurring your eyes, try and do it right now. Blur your eyes at the screen and you can kind of see there's a few little tops that kind of come in right in and around here, right? And if I blurred my eyes, it happens to line up with that Fibonacci. Actually, if you blurred your eyes, it might go a little bit higher there. But at the end of the day, you can kind of see those and check out the overall market move, right? And looks like right here, there is starting to be a candle that is a bearish pattern there, or setting up for a bearish pattern. Let me erase all of this stuff so you can see it a little bit easier. You can see that bearish pattern setting up now a little bit easier. That little candle is something I usually look for. What do you guys look for when you're looking for swing trade setups or markets starting to switch over? Candles like this are huge for me at the top or bottom of a move. Anytime I see those types of candles, here's another one a little bit different. It's a little bit stretched out, but those are things that I really look for topping patterns, okay? So in this case, that would have been me looking at a neutral trend with a bearish pattern setup for this trade. And you can see that, you know, time and time again, this trade has worked out when you found, depending on where your line was, I'm a little bit more aggressive. So I would have picked something like these two lines there for my entry and exits. But you can see it does pierce through. So you are going to see that it doesn't always, you know, work out exactly right where you can see that and it pops up here and starts trading again before it resumes down, right? So you can see it break out of those patterns and do crazy things like that. It's not always going to hit that resistance and stop, folks. But when you've seen it happen multiple times, you know that that's going to be a resistance area and good strike location, especially when you're using options, folks, because when you're doing outrights, if you're doing say an ETF and you're long and short this thing, really you're beholden to that market move the time that you put that trade on. Whereas when we're dealing with options, especially with this strategy here, that we don't always have to be Einstein and pick the right strategy, or sorry, pick the right directional assumption. We could be directionally right in a situation like this, or directionally wrong in a situation like this, and the market pops up there. But because we used options and our strike location is at a advantageous level versus just going out there and selling this, you know, you would be a little bent if it popped up there like that on you the next day after putting on a trade. You know, might be a little bent with the options, but it's not going to hurt nearly as much because your option location, especially with this strategy, is much further away, and the probabilities of success are much better than if you were to do it otherwise. But this is a situation where we could see that previously we had looked at a setup there. Now, if you are newer to options trading or swing trades, this trade was not confirmed, which means that we had a candle like this, and one would generally say that you wait for a red candle to confirm that top. This would be the confirmation. I didn't wait for that, and I usually don't. I'm usually a little bit earlier, but I have a higher risk tolerance. I would suggest anybody newer to trading would wait for this candle the next day. And if it doesn't happen, you don't enter that trade. But having said that, with this type of trade, you know, selling options, your strike location would be up in this area somewhere. Especially the way that I teach on the strike location, it would have been up there and above 136. It was right around 136 at this time. So yes, it got up there and got tested, but much less painful than a trade where you were short this underlying, right? So how to swing trade? Let's just go over this real quick before we get into options. First step is to identify that overarching trend, whether it's bullish, market neutral, or bearish, right? And then we're going to try to find those support and resistances. Whether you use Fibonacci's, I use Fibonacci's a lot. The market profile, which is that little blue thing over there on the side of my charts, or you kind of blur your lines, which I have no problem doing. When you blur your eyes and blur those lines a little bit, you can kind of see it a little bit better sometimes. It doesn't always have to be the perfect candlestick chart setup like I was just talking about. Sometimes when you blur your eyes and you can see those different changes in momentum a little bit easier than necessarily looking at chart setups. So, and then finally, the one that we're going to be doing our trade on is that pattern within all of this other stuff, the overall trend. Then we're going to try and find that pattern reversal when it hits those support and resistances is the best case scenario. Usually when they get close and I start seeing these chart setups, then that's when I'm going to start looking for an opportunity. Oh, sorry. Why options though? Because you have better odds, folks. You have better odds of success than using an outright, okay? I don't care if it's bullish, bearish, or market neutral. You have better odds using the options. And if you are wanting to take advantage of a dollar for dollar move, you could still use options using like a synthetic long or synthetic short, bearish risk reversal, all those ones that I've already covered. You will use less margin than going out there and having to buy the underlying outright, okay? And I show you how that all works out in those webinars. I'm not going to go over all that right now. But when you know you have better odds, you are able to keep your powder dry, folks. You're not going to be so antsy to cover this on every tick in your favor or every tick against you, all right? What you have to do is stay mechanical with this, not think about money. That, folks, there's one thing I learned very early on in my trading career was that if you are trading and kind of saying, I need to make this much money per day, you're putting a dollar amount on that. You're putting emotion behind that trade. Stop that. You want to look at everything mechanically and break it down, okay? And what I try to do is make you look at this stuff logically. And if it is logical, when it is logical, then you will be able to look at it and discern, hey, you know what? I'm probably being a little emotional about this. The probabilities are in my favor. Yes, it's gone up there and it's tested that, but you have the knowledge. And if you know what is happening, all of these levers and pulleys with these options, you will stay mechanical. I mean, we just saw what happened with Robinhood and their options traders, you know, so I don't want that to ever happen to you folks where you're beholden to one of these brokerage firms necessarily to teach you trading, right? They just want you to bang it out. All right. They make the money on your transaction. So it doesn't always behoove them to keep you mechanical. All right. All right. So, but when we can see this with those types of patterns, again, we got a second one on this. You could re-enter on a level like this because it actually came up and hit another resistance. So that's something I always like to look at. If I have two resistances, that are pretty close in line here. I thought that this was a really good strike location. This is probably even a better strike location. So something to talk about with your trading. Now, when you're trading options, folks, remember every one contract is equivalent to 100 of that underlying. So when you are trading options coming from the futures or you're coming from just trading stocks, know that if you trade one option contract, it is equivalent to 100 of the underlying, all right? That being said, don't go in there and do like 10 contracts in IBM if you aren't used to doing 1,000 contracts in IBM trading, okay? You don't just jack up your size because you're given the margin or the opportunity to do that. What you want to do is use that opportunity to create more trades and diversify your portfolio, create more hedging rather than jamming it all into one trade. As a matter of fact, I'm getting off on a little side tangent here on portfolio theory, but I would never allocate any more than 5 to 10% of a portfolio to any one trade, okay? I don't care how sure you are about a trade. It is not worth throwing all your money at, folks, all right? Ramp it up maybe to 10% or something like that if you're normally doing about 5%. But problem is if you get over that, you stop, your mechanical trading breaks down because you become more emotional. Every tick is risk against your portfolio, major risk, all right? So stay away from that. No matter how sure you are, play the probabilities and keep mechanical. All right. Again, just looking at overall things, we can see that this is obviously a bullish trend, right? And looking for support and resistances there. On this one, really, this would be right in the middle of the road, might be the location to be looking to get out of something like that. You could do that too if you have a lower risk tolerance. The idea would be it pops against those support levels. It comes up to about that mid-level, especially if you're using trend channels. That would be the ideal location to get out of it, wait for it to hit the upper band and re-enter from a short position, all right? So the idea for lower risk tolerant is get in when it hits the bands and then get out when it hits that midline there. For higher risk tolerant people, I say when it comes within, a certain range, if it comes within a nice little close area, that's when I'm starting to get interested. It doesn't always have to hit that line for me. I'm going to be a little bit more aggressive, generally speaking. All right, so let's take a look at this trade. Again, what happens here is we're looking at, this is an overall bullish trend, right? I kind of zoomed in on this so you don't get the full 52 week, but you can see at the top of this move, we started getting some nice little topping patterns where we started losing momentum. It's not stuff that you write books about, but we got the confirmation basically on the 10th. We started getting that pullback. That's, if you guys remember, when we were doing this webinar last week, right? I talked about the short call spread with EWZ. Well, just so you know, at that time, I also did a short call because I wanted to really explain, some of the nuances with these options, right? Well, when you're looking at a short call spread, you've often been told that is a limited risk strategy for a lower risk tolerant person. That's probably where you should go. Well, yes and no, because I look at it, the short call spread has a higher probability of being in the money or have a higher probability of loss, there's less likelihood of a winning trade than my short call outright, has a higher probability of being out of the money, but I have risk completely to the upside, all right? But if I don't have to, I probably am not going to have to stay in this trade as long if I just have the short call versus the short call spread, all right? Because when the market starts going against me with the short call spread, remember, I've got that long call that kind of offsets some of it, all right? And that will hurt me in the long run, especially if volatility starts coming out of it and those things. It will offset some of the other aspects of that trade. So we set up a short call spread based on this. I also did a short call based on this trade, and we'll go through that whole thing after I go through these options that definitions really quick for some of the newer folks. Some of you guys that are a little bit used to trading options, please bear with us. And maybe I got something to help you remember some of this stuff too. But one of the things we all want to know is what happens to the call buyer? Well, if you buy a call, you have the right but not the obligation to buy the stock at that strike price, right? So if XYZ, let's just say XYZ is trading 100, right? And I buy a call at 105. So I'm buying the 105 call. It's a little bit higher than where I'm at. Now, that gives me the right, if I bought this 105 call, I have the right but not the obligation to buy XYZ stock at 105. Do I want to do that today if it's trading 100? No. I can buy it up for $100, right? Why would I pay 105 when I could buy it for 100? Doesn't make sense. So you would never offset that trade or use your right or make the seller sell it to you at 105. He would be happy. All I can think of is a bad word. If you did that for him, right? So the buyer has a right but not the obligation to buy the stock. So if my call is above where the underlying is going to do it, I'm not going to do anything. But if XYZ goes up to 125 and I have the right to buy it at 105, would you want to do it? Would you want to buy something at 105 when it's trading 120? Absolutely. There's a huge amount of value in that. All right. Now, you don't always want to go through that assignment, that process. It's probably better to just get out of the trade just because it's going to save you money on commissions. But that is the aspect. If a call is higher than where I bought it, or the underlying is higher than where I bought the call, then there's an immense value in that. And therefore, it's going to be reflected in the price. All right. But if that 105 call at the end of the day, or when this option starts to expire, does anybody want to buy it at 105 when it's trading 100? No. So it will expire worthless. All right. Or it's going to have no money in it. And for instance, if you bought or if you sold the call, let's do the call first, right? If you sold the call, you have the obligation to deliver that stock. So if I'm the call seller, that means that I have to sell XYZ at the strike I collected a premium for. So if I sold this 105 call, if I sold that 105 call and I collected $1 for it, I get to keep that dollar no matter what. I don't care if it's trading 120 and I have to give you the stock at 105, I still got to keep that dollar. All right. But if it goes down or stays where it currently is, then I get to keep that dollar and that option expires worthless because there's no way you're going to come to me and say, hey, I want to buy this stock from you at 105. I'll be happy to sell it to you there and offset it in the market, but nobody's going to do that. And if you're a put buyer, you have the right but not the obligation to sell that stock. All right. So if I bought a put and it XYZ, about a 95 put, and XYZ starts trading down, well, that put becomes more valuable because I can sell it higher than where it's trading, right? So I will be paid offset by the amount of money my underlying is in or is higher that, or if the underlying is lower than where my put is, I'm going to be paid by that difference. Okay, I will always have that difference embedded in my price of my strike. Okay, and the seller has the obligation to take delivery or buy it at whatever strike. Okay. All right. Now, when we're talking about options, there's pricing we're talking about, right? If I'm a buyer of a call, I buy that 105 call that I was talking about. I have to pay a price for that. All right. Now, what I need to determine, though, if I'm a buyer of an option or even a seller of an option, I have to be a good steward of capital and know if I'm buying something super cheap or if I'm selling it or if these premiums are super expensive. I don't want to be buying it when it's super high, do I? Right? If I'm buying a call and it's super expensive, do you want to buy high and sell low? You probably are asking me, how do you know? How do you even know if the options are cheap or expensive, right? Well, you come over to the option montage and look at Vega. Vega is implied volatility, right? Well, you can't really tell, though, if 30 is high or low for EWZ. right? You can see 30, 40 in here. Those numbers are telling us that the pricing in the options can adjust by that. Because Vega, which is implied volatility, all of the Greeks talk about a movement of one, right? Delta will tell you how much your price is going to adjust by $1 move in the underlying. Vega, if volatility in this underlying increases by 1 percentage point, then my premiums are going to increase by the amount correlated to that strike, okay? So if volatility increases, our premiums increase by that amount. Does that make sense for everybody? Please feel free to comment over there on the side if you have any questions throughout this. And vice versa, if volatility starts going down, a negative move makes those coefficients in Vega negative, all right? So then premiums start coming out as volatility comes out, all right? So implied volatility is one of the most important aspects of trading options, folks. It is really what is going to determine whether or not you're buying options or selling options, because this number over here tells you if these premiums are expensive or cheap. Now, I'm not just talking about that number 30, because 30 could be high for EWZ and low, like Tesla will never get down to 30s, 40s, all right? It might get down into the 70s or 80s, but it's never probably been down into the 30s. So when I'm looking at Tesla and I saw a 30, I would know that that was really cheap. But EWZ, by just looking at the option montage or this page in the options, I can't tell by looking at Vega what my premiums are. It is implied volatility, so we can just flip over to our implied volatility, which is down here. You can see I've got implied volatility as a chart. And one thing we know with implied volatility, all these underlyings have a relatively tight range or a relatively good solid range as to where they see resistance on their volatilities and where they find support on their volatilities. And you'll see this on the chart coming across on any one of them if you throw this at the bottom. Now, you can see at the time of this trend, or at the time I took this snapshot, volatility was really spiking in EWZ, right? And one thing that we know is that when it's at this higher, if I know that where my resistance is, my supports are, even in the implied volatility chart here, well, I could see that this is up near some resistance area, or it's elevated to that point, right? So when we're looking at this, we can zoom in and do some detailed analysis here. If you want to know the math, basically you take the current implied volatility minus the low volatility, implied volatility, and then you divide that sum by the high implied volatility minus the low volatility. And you'll find it on this chart. We're going to say that that top right here is right around 58. I'm going to call it 58. We'll say that this low right here is right around 28. Throw it out there. And we got 54, right? So I go 54 minus 28. Take that sum and divide it by the high and the low, which is 58 minus 28. So basically I have a difference of 26 over 30, which equals about an 87, I'm going to say 87%-ish. So definitely upper bounds. And I usually say that this is sell zone, like you're selling premium when it's above the 50 mark. This is 50%. And you buy down here. We also have strategies for when it's trading right around there that for when you don't really know where volatility is going to go. But usually when it's down below that mid mark, you know, the idea is it's going to want to migrate back to that mean, all right? And when it's extended over to this upside, it wants to kind of migrate back down. Now, when I took this snapshot, volatility actually started coming out of this underlying throughout that day. So volatility ended up the day down here. So you can see volatility fluctuate that much in a matter of moments. As a matter of fact, when I started doing these screenshots, by the time I got to the trade, volatility had started dramatically coming out. But we could see, even if it came out a little bit, we were still elevated volatilities, which meant those premiums over there in the option montage are at the highest level we've seen in the last 6 months at least. All right. I do my Thinkorswim does this for 52 weeks. I have the script where I do it for the last 6 months. And the reason why is because volatility has been all over the place. Remember, 2020, volatility through the roof. And now we're looking at when volatility dips back into the teens, which is historically high volatility. It seems like volatility is just gone. So we're seeing volatility fluctuate quite rapidly, even during the day sessions. But anyway, with this trade, we could see during the time when I was initiating this trade, making my decision, I had high implied volatility. That's all I can do is base it on that moment, right? So when I'm going through that process, I determined that these prices are expensive in the option montage because that implied volatility was right now at an elevated level. Does that make sense for everybody? Make sense? Yeah. If volatility really is a major determining factor, at least in my eyes, of the pricing at any given time, yeah, the underlying moving does that, right? But we also can watch the underlying move up and down and kind of know what's happening. Volatility is kind of like behind the curtain over there, and it's adjusting your pricing, at any given moment, and you might see the underlying start to rally, but if volatility is coming out and you bought a call, well, you might be wondering, why aren't I making money in this rally? Well, it's because maybe you set it up incorrectly in an environment where volatility came out. You maybe bought that call in really high volatility. All right, so we know that they're expensive, and if we know that they're expensive, we know that we want to be selling options. Selling options, right? All right. One other thing we got to talk about. Theta, this thief. Yeah, I know you guys are like, he's sneaking these Greeks in on me. Just remember Theta as the thief, okay? That's the easiest way to remember because every single night this thief comes in and picks your pocket. You could also think of Theta as the tax man. He comes in every night and picks your premiums. But one thing to note about Theta is it's not like linear. It's not equal every single day. What happens is, when we first put on this trade, it might be, $1. The next day, it might be $1.50. Next day, then it's $2. So it starts ramping up the closer and closer we get to expiration, all right? So it starts increasing. And we can see that on a chart, kind of like this one. Sorry, I guess. Why isn't that racing? So we can see out here in time, Theta does not really even know you exist. So he's maybe taking a penny out of your pocket or, $1 or two, but you come in here and then this is where he really starts ramping up. You can see basically from 35 days to 7 days, you have a 50% drop in those premiums. All right. So what I'm talking is this is your sell zone, because if Theta is picking away at your pocket, well, if you sell high and that Theta helps you out, that's what you want, right? And if you're buying options, doing something for a debit, you want to get out here and limit that Theta decay. All right. So if I have, let's go back through this step real quick. If I have an underlying where I have a bearish market assumption and I know those premiums are really expensive, what am I leaning towards? I'm leaning towards selling high premium. I'm trying to sell volatility in a sense. So if I'm selling something and I expect that volatility to come out, I want to sell high and buy low. I want to get inside of this basically as close to 35 days to expiration as you can. 45 days is, like basically less than 45 days to expiration is really the sweet spot. And if you get inside of 21 days to expiration, that's probably where you're going to be looking a little bit further out, and it's going to be closer to 45 days to expiration. All right. Because you get inside that 21 days to expiration, a lot of that premium has already come out, and it's just not going to be very much premium left in those options. All right. So another way we can look at this thief in the night that comes and takes our premiums, I just used SPY as an example. Why? Because we're looking at theta on the calls and the puts. We can see theta is always negative, right? Because every single night he takes premium out of the calls and the puts. All right. So if we look at theta with like 23 days to go, you can see every night 12 cents is coming out of this premium. All right. If I look at 58 days to go, we can see that only 8 cents is coming out of those premiums. And, 86 days, 7 days, right? So I'm not getting any benefit if I go and sell to June, right? I'm not getting any benefit for the next 30 days of that theta ramping up. So I would want to get as close to that 45 days. So it'd probably be it would be a pick in between these two, actually, on this particular one. But I would probably default back to further days to expiration, get more premium, allow me to get a little further away from where the underlying's trading and watch that theta really ramp up. So I would usually default to going a little bit further out in time. And if we look at the example of EWZ, again, you can see 35 days to expiration. We were looking at a 2 cent coefficient, and you can see it starts ramping up. The at the monies are a little bit off, but you can see it almost doubles when we start getting closer to those at the monies there, from 2 cents to 4 cents on the 41.5 strike. And if you look way back out here, it only goes from basically 1 cent to 2 cents in those 35 days. Okay. So obviously you want that theta to be ramping up when you implement this strategy. You don't want to be sitting there just watching it kind of not do anything. I mean, that's the worst case scenario, right? You want volatility coming out and you want that theta just working. That way, if EWZ stays here at 41.13 for the foreseeable future, I still make money. All right. So with this one, what I would be looking for on this trade, all right, let's just do a real quick review, is I've got high implied volatility. That means the premiums are expensive. I'm leaning towards selling an option, right? And this is the same example we used last week with the short call spread. I think it was last week for the short call spread, where we implemented it around this strategy because of the high volatility. I actually jumped in there and added a short call. I did the short call spread in my IRA, and I did the short call in my trading account. And I did it at the same time because I wanted to show how these both reacted during the exact same time, and talk a little bit about this risk reward that we would be talking about. So in this one, we're going to be basing this trade off of the short call. Now with the short call versus the short call spread, obviously you need a little bit higher risk tolerance, quote unquote, all right, because there is unlimited risk to the upside. I do not want to downplay that with this strategy. There is unlimited risk to the upside. The short call spread has limited risk, okay? So if you are worried about that, obviously you want to go for the short call spread. You have to have a lot more patience with the short call spread than you would with a short call, though. Short call will, if you get your directional move right, will be much more profitable quickly than that spread. It's going to take a lot longer for that spread to kind of work itself out. All right, I know you guys want this strikes already, but first we want to talk about delta. Why? Because delta tells us a lot of things. On the floor, we used to call it data. So it's basically data. It gives you all kinds. It gives you the probabilities of being in the money. It gives you the rate of change to your premiums. And with this one, I want to specifically talk about the probabilities right now. Yes, one thing to know, it's the rate of change in an option premium. That means when the underlying moves up by $1, XYZ moves up by $1, then let's say my options will adjust by the correlating delta, all right? So calls are positive delta, puts are negative delta, right? So the underlying moved higher by $1, the calls would increase by that delta, the puts would decrease by that delta, right? The underlying moves down by $1, the puts increase, right? Because a negative move plus a negative delta makes it a positive delta, right? Makes sense for everybody so far? So it does give us the rate of change in the premium, but it also is data. It tells us our probabilities of being in the money. Being in the money. All right, probability of being in the money. So if it's a 16 delta, I have a 16% probability of being in the money. A 40 delta, I only have a 40% probability of being in the money. All right, and they also adjust the premiums. It's the same thing. So when we're talking about strikes, standard deviation curve. Standard deviations line up with delta, all right? So if we are talking about a 1 standard deviation move, right, that means the probabilities of this happening at the 1 standard deviation is right around a 16% chance of this happening, all right? And basically right here, we're talking about mid-30s, and this is about a half a standard deviation move. So when we were talking about the call spread, we were doing the call spread at the half standard deviation strike, setting that up right around that. Remember, selling around the 36 delta and buying the option that allows me to collect a third the width of the spread. That's what we talked about in the call spread webinar, right? This is a slide from that. We're selling that 36 delta call, and then we're buying an out of the money call, trying to create that spread where we collect a third the width of the spread. Well, that strike location was right here on the call spread. I'm talking about when you sell a naked call, you're out there at that 16 delta, right? So this short call is really at the location, or very close to that location, where we were defining our upside risk, right? That's where we were buying that long call to define that risk. Well, this short call is at around that same location. So when you're doing the short call spread, your short call has a higher probability of being in the money than when you're dealing with a naked short strategy. So, you have to weigh your risk tolerance versus how new of a trader you are. If you're trading in an IRA, you're not going to be able to do a short call, all right? You're going to have to go to the short call spread, which means you're going to be a little bit closer. But I would encourage you, when you're trading options, to always kind of stretch a little bit of your comfort zone. And I'm not saying go all in, like if you do 5 call spreads, you go in and do 5 short calls. No, I would say you'd probably go in there and do 1 short call on an underlying to get used to that risk for the trade. So with this trade, I'm looking at the 16 delta. Now, some of you guys would be like, hey, I don't get any money for a 16 delta. I need more, collect more money. Well, the range really is to a newer risk trader or newer trader to options, look for that 16 delta. It's further out of the money. You only have a 16% chance of being in the money. That means basically 8 out of 10 times, better than 8 out of 10 times, you're going to be making money. All right. If you want to go to the 36 delta, I have no problem with that, especially if it's a great setup. You got a nice topping pattern, or it's bumped up against the Fibonacci, a lot of things in your favor, then yeah, you can be aggressive. I wouldn't go necessarily much tighter than that 36 delta. All right. That's usually where I'll stop on selling a call or selling a put, is right around that 36 delta. Okay. And that would be very aggressive. And like I said, when we were looking at the call spread, we started out around that 36 delta. Let's just review this trade on the call spread. Because remember, I got involved on this sell-off on this day. That confirmation of that sell-off was the catalyst to get me involved in both of these. I had high volatility, right? So I knew that the premiums were elevated, and I saw the pattern rolling over, all right? So I was looking for a bearish trade for that bearish pattern trade, and we had high implied volatility, right? So I set it up like this, where I did the $42 wide, collecting 33 cents, right? That's collecting a third the width of the spread. And I sold the 42s I sold the 42s and I bought the 43s, right? To define that risk. Well, on that same day, I got aggressive with our short call, but I went in and did the 36 delta. Why did I pick that 36 delta? For one, I love the setup on this trade. So I wanted to be a little bit more aggressive. And two, let's go back to this page. Note that that 36 delta is, or it's the 34 delta, lines up right in between my spread. So it kind of worked out quite nicely there. The spread, I'm 42.43, right? I collected 33 cents on that, on the spread. So my break even is 42.33, all right, on the upside. When I'm selling these calls, my break even, I'm short a call that's above my break even of the spread. Does that make sense? I'm selling it at 42.5. So my original trade is higher than where this spread had to be set up. So let's go through this on that 36 delta trade, because I got a little bit more aggressive, partly because of, I wanted to show you how long these trades will have a tendency to take to work out. And I actually ended up getting this trade for 80 cents. So selling this trade, got it. I sold this one for 80. Remember, I sold the 42.43 spread for 33 cents. I sold this one, the 42.5 strike, and collected 80 cents. That puts my break even, collection plus my strike is my break even there. So $43.30 is my break even. 43, what did I say? 43.30 is my break even. That's above my defined risk strategy, right? My break even on the short call is above where my defined risk strategy max loss was, all right? So again, for me, I do have a higher risk tolerance, and I've been trading for a while. I would rather personally, especially on a very bearish assumption, do the short call versus the call spread for these very reasons. My break even's higher on the short call, right? My probabilities of success are much higher. Yes, I do have unlimited risk to the upside, but I also have higher profit potential if this starts rolling over. I can get out quicker too. I'll show you that, as a matter of fact, here in a moment. So with this trade, today I took this screenshot. We got this market moving. Now remember that 42.43 call spread? I was trying to get out today for 9 and 10 cents, right? That's basically a 23-cent winner. That's a pretty good winner. I'm basically, 2/3 of my max profit. That is absolutely where I would say to get out of a spread like this, 10 cents on a 33-cent collection. Usually I say you want to get out around 50 to 75% of your max profit on this trade. So, if you collect at $1, then you want to get out for 50 cents, all right? Or if you collect at $1, if you have a higher risk tolerance, or this thing's really moving nicely, get out for that 25 cents. So, what I usually look at it is if I'm in this trade for a very short period of time, I'm willing to take a little bit less than my max profit potential. All right. You get that move quickly, get out. You might see a situation like in this one, when I got in on this downward move, right? I could have gotten out of the short calls. The short call spread wasn't working out for me. So I stayed in on this short call just to show, how long it takes for the short call spread to really work out. Well, a couple of things here. The nice thing is it came back up, retested that resistance area because of my strike location. Remember, I'm short 42 calls. My break even is up at 42.33 for the spread. And then my short calls, even better strike location, right? Well above there. But we retested that. And the problem with the short call spread is it was because it never came anywhere close to a place where I could get out for probably even 50% of max profit, which wouldn't be that much of a winner. The short call has worked out a couple of times. Right now, I sold that short call, did I put it in there for 80 cents? Today it was trading around 10, 11 cents for the better part of the day. I could have probably gotten out easily from my short call that I initiated on the same day as the short call spread. Now that short call spread, I'm trying to, make 20 cents on it. I'm already up 70 cents on the short call. That carries a lot more risk, right? To me, it's like, yes, it does carry a lot more risk, but I can get out of this thing so quickly if I've set up the levers and pulleys in my favor, right? Volatility comes out. I get the directional move in my favor. Then I can get out of this quickly. Problem with volatility and the spread is the volatility is going to offset because I've got a short call and a long call. So they're going to meld each other out a little bit. And same with the Theta and Delta, right? If I'm short one and bought one, it's really, they're melding each other out. One's working for you and the other one's working against you, right? So to me, I like to lean towards the naked strategies, but I would never encourage you to do that until you are a little bit more comfortable with trading options. Make sense for everybody so far? All right. So when do we get out of these trades, right? When do I get out? I told you I'm looking at about 50% of max profit. For like a newer trader, or if you're just starting to step up to getting into naked options, right? Go for the 50% of max profit, and if it's less than 15 days, if you're only in it for like 3 or 4 days and you're up like 25% of max profit, it'd be hard for me to not cover that trade, right? I'm looking to hit jabs, boom, 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 right? That's what I want to do. Less than 5-10 days and I'm like 25% of my max profit, I'll probably look to cover that just in case there's a bounce, I can re-enter or something. In this case, I didn't take advantage of that opportunity, but today, like I said, it's right there with my call spread. I can't really get out of it for really, much profit. I sold it for 33. It's trading around 10. That's a decent profit, but on the other one that I sold at the same time was always a winner. The call spread, when it rallied up there and hit that high there, that call spread was turning into a loser. The short calls were basically at break even or at a scratch. My premiums, increased on this little move, but over that time, that Theta had helped me out. All right. On that trade. And yes, it looks like volatility is increasing here, but remember on that chart I showed you, I got involved when volatility had spiked during the day. It finished the day lower, but during the time or during the day session, that volatility had spiked up quite dramatically. I got involved in the trade. It came out a little bit, but that's what we're trying to do, is set it up when we have the high volatility before it comes out. Right? So on a swing trade, what I always suggest, if you're entering and exiting based on the swing, for instance, I entered on this down day here. So basically a break above the setup bar. So for me, I got involved on here. So basically above that Fibonacci, the setup bar, not the confirmation bar, but the setup bar, the one that is before the day before that confirmation, I get out on the setup bar high. All right. And as you can see, the market rallied up. We didn't really pierce that. We came up and bumped up against it and then continued to sell off. So if I were short this underlying, that would have been painful. I probably would have been out on this little bit of a bounce. But the beauty in options is I knew I was above this resistance area. We could retest it and fail. That's what I was looking for, and that's what happened. So it worked out. So because I set this strike location up in an area, above a nice resistance, it comes back and retests. I'm not really too worried about that because I know I have good strike location on it. All right. And on the downside, like I said, 50% of max profit, higher risk tolerant people, go for 75. Don't try and squeeze out every last dime. All right. I'm trying to get out for a dime. I'm going to have a GTC in there to get out for a dime on my short calls. Okay. Because that extra 10 cents or that extra $10 or $100 does actually, it's $10 to my thing. It's not that much, $10 for every one lot. It's not enough to make up for just a snapback and then I lose all of it. All right. So usually on short nakeds, I'm getting out 50 to 75% of max profit on this trade, and on a loser when it breaks above my setup bar. All right. Or breaks my resistance. If it broke this resistance area, I would have been out of it as well. And I talked about setting up this trade based on trying to cover this gap that we have on EWZ. So we'll see. Tomorrow, I haven't covered it. Check out the daily market commentaries where I talk about all my trades, when, where, and why I'm putting them on, taking them off. And I'll probably be talking about this one tomorrow because I was pretty antsy to cover that trade today. I just couldn't get out of my spread. So I'm going to be trying to do that tomorrow. Max profit on this trade, the short strike, or your max profit on this trade is your premium. Your break even is your short strike price plus that premium. All right. And remember, your max loss, I cannot emphasize this enough. It will continue to lose money as the underlying rallies. All right. So be mechanical, get out when the setup's broken or whatever, change and reversal you see, the momentum move. Don't feel like you always have to take out every penny of an option trade. It starts moving the wrong way on you. Get out of it. Pull the ripcord. Wait for it to start setting up. Wait for a better setup. Okay. Don't force yourself into trading because then you break down on your mechanics again. All right, folks, without any further questions, check this out. This is going to be the link I'm throwing over there in the chat window. You guys should get that over there. You can hit that hot link to go straight to this. This gives you over 15 hours of content. You're going to be able to spot trades using that market profile. I'll show you how to trade that blue side profile that we had on the charts. That's the market profile. To me, that tells you the psychology of the market, where people are trading, where they find value. And that is huge. Quickly understand when, where, and why we're trading these options. I mean, folks, you guys should take advantage of this. It's setting up my platform. If you take advantage of this, you can get that the code for the last 6 months implied volatility, because 6 months before that we were in a different world. So make sure you take advantage of that script that you can throw over there in the watch list if you're on Thinkorswim. Ultimately, if you click on that link, this is the page it's going to bring you to. You guys can reach out to us, 310-598-6677. There's going to be a link down there in the descriptions box also. You can click on that. If you guys are new to this type of video, you liked what you've seen, you guys enjoyed my content, please hit that subscribe button there because that will give you notifications when we're doing these videos. I also talked, if you showed up late, I do daily market commentaries where I'm implementing these option strategies on any given day, and I will go over when, where, and why I'm implementing those, strike location, all of those beautiful things, and win, lose, or draw. I'm not cherry picking, folks. I'm not that guy that goes out there and goes, had you done this strategy, you would have been up 1,000%. No, I'm doing my trades daily, getting in and out of them. You guys know specifically when I get in and when I get out, whether it's a win, lose, or a draw. All right. I'm not cherry picking anything. So click on that link. It'll take you to this page. You get all kinds of stuff there. How to even trade using Gamma. If you guys like really short-term, volatile type of trading atmospheres, trading Gamma is the way to go. If you want to be on the edge of your seat, I'll show you how to do that there too as well. All right. Thank you guys all. Again, here's the phone number, 310-598-6677. If you have any ideas for future webinars, please reach out to us, trading@protraderstrategies.com. Again, if you're watching this on tape delay, the link's down there in the descriptions box. All right. Thank you guys all. I do really appreciate you guys taking the time to spend with me today. I appreciate it. Thank you for the kind words, Jeffrey. And check us out tomorrow doing the daily market commentary. We'll talk about this trade and see how it shakes out. All right. That's all I got for you guys. One last thing. If you can't smash that, take that. Bye for now. Take care, y'all. Nobody has any other questions? I'm going to let you guys go. All right. Bye for now.